Welcome to this week's Property Insider video. In our monthly deep dive into property data, today Dr. Andrew Wilson goes through what's happening in our property markets in each state, what's happening to our auction markets, what properties are selling and what are not, what regions are performing better than others, what's happening to asking prices, rentals and vacancy rates. So you're going to have a much better understanding of what's happening in our property markets, particularly when at the end he gives you his predictions, his forecasts of where property values are going to finish up for 2020. If you want to keep up to date with all the latest property market data, please subscribe to this YouTube channel and click the little bell icon so YouTube lets you know when we have a new show each week. What an interesting week it's been, not just in property but in the world. Now, a couple of days ago, a curious headline from a major news outlet, in fact Australia's largest news outlet, came across my computer screen warning Australian housing markets could see a historic crash. In fact, the subheading said, it's a worrying sign that Australian housing markets in one state could see price falls more than double the 2008 US housing crash. Now, of course, I took the clickbait and I read the article only to find an inexperienced journalist had misinterpreted data, but was able to find some of those perma bears out there to corroborate her story idea. But then what surprised me more was there was a link in the article. You know how those news sites include links to other articles. And this article in the same major news site stated housing markets are back for buyers and it's a rising market. What gives? Well, I found that during boom times, all the news articles are positive, and when our markets are facing difficulties, all the news articles are negative. However, at turning points in the property cycle, you get a mixture of good news and bad messages as people are still trying to figure out what's happening. And that's why I look forward to my chat today with Dr. Andrew Wilson, Chief Economist of My Housing Market, who's going to tell us what's really happening on the ground. Hi, Andrew.
Hello, Michael. Yes, I nearly fell off my chair when you told me about that headline. I thought, not certainly, how can we possibly justify that under current circumstances? And I would have thought the doomsayers would have headed for the hills by now, given how completely wrong they have proven to be yet again this year. Yawn. And I guess I could say that stupidity is really becoming an art form in some sections of the media, but I won't say that.
The housing bears are running scared. You're right. That 1 in 100-year pandemic that we've worked our way through had not just the perma bears, the negative Nellies suckered, but it also had a lot of the more regular property commentators confused. Westpac, NAB, ANZ, CBA thought there could be price falls of 10%. UBS said 15%, AMP 20%, and SQM Research said up to 30% falls. But we've been on record in these weekly videos being much less pessimistic. And now, around 6 months after the COVID-19 first hit our property markets, the property markets are showing signs that they've turned the corner following a relatively mild downturn. Now, sure, this has been supported by the government throwing a lifeline at mortgage holders, at tenants as well, and as well the RBA and the banks have supported our housing markets. And Andrew, we get a lot of comments on this YouTube channel from people who are suggesting we're in a Ponzi scheme, the government's supporting us. Yes, they are. But isn't that what the government's job is, to look after its constituents? It does this by providing hospitals and ambulances, schools and police, a range of facilities, infrastructure. But it's also protecting the wealth of that 70% of Australians who own their own home and they use their home as shelter. The government's recognised the importance of feeling secure in your own home and how devastating the economy would be if the property markets fell significantly. And I think it's done its job well. It learned from previous economic downturns. It got in early. It threw everything, including the kitchen sink, at minimising the impact of the recession. And way back, I remember Scott Morrison said he's building a bridge across the other side. And it looks like we've gotten to the other side. So let's have a look at this monthly deep dive into the property markets. We normally do it in the first week of the month, but last week we discussed the Reserve Bank's important decisions. So what does the data tell us this month, Andrew?
Yes, thank you, Michael. And let's have a look at the week that was in the housing market again. And we start off as usual with the weekend auction market results. Another strong weekend for capital city auction markets, Michael. Clearance rates still not reaching 80% in Sydney, but gee, they're not far short of that. I guess we use it as a boom time benchmark, 80% clearance rate, but still very strong results, down a little bit on the weekend before. I think, Michael, one of the issues with auction markets going forward we need to be mindful of is we are going to see higher numbers of properties, as we always do towards the end of the season. And that tends to put downward pressure on clearance rates as we get more supply coming through Melbourne. And certainly a lot different to where we were a month ago in terms of clearance rates in Melbourne, 73%, down a little bit on the weekend before. But I think we had a holiday weekend in Melbourne for the Melbourne Cup Festival, Michael, if we could still call it that. And of course, we had another big rise in listings in Melbourne, still well below where they were at the same time last year. But nonetheless, again, it's that supply perhaps in the shorter term catching up with demand that helped to ease those clearance rates in Melbourne. Other capital city markets are quite strong. Brisbane back to where it normally is in those mid 40% range for clearance rates. However, Adelaide and Canberra very strong, over 80% in Adelaide, and another strong result in Canberra, which overall really still appeals as the strongest market in the country, capital city market. But there's no sign there of any easing in buyer and seller activity, Michael, in our weekend auction markets. And as I said, numbers will rise going forward. We see the trend there still clearly upwards for Sydney. Top performers in Sydney last weekend were the southern suburbs and the Central Coast. And the top selling property was a beautiful home in Bellevue Hill, which went for over $16 million. So, Michael, big price there for a luxury property in a top shelf suburb in Sydney. Melbourne, we see that roller coaster ride in terms of its clearance rate journey through COVID shutdown. Now well and truly up and running again, that Melbourne auction clearance rate. And as we can see, interestingly enough, not far away from where it was at the same time last year, Michael, but of course, we had higher volumes of listings then, so there were more properties actually transacting. But still, the clearance rates are similar to a year ago in Melbourne. Top performer in Melbourne last weekend was the northeastern suburbs. And the northeastern suburbs, Michael, have been quite a strong focus over the last couple of years in Melbourne. I think that really appeals as an affordable, still leafy type suburban destination. And not only did it have the top clearance rate, a very strong 83.4%, but from the highest number of listings as well, reported listings as well. So good results there in the northeast. Top seller in Melbourne last weekend, reported under the hammer, was a beautiful Edwardian property in Bamfield Street, Sandringham. I think that's part of the old Buxton estate there, Michael. Sold for over $5 million. Certainly prices in the luxury bracket in Melbourne are lower than Sydney, but the quality is still certainly the same. And that was a wonderful result for a beautiful property. And if we look at the premium suburb Melbourne results, these are the inner suburbs of Melbourne. The top seller was, again, an old Edwardian property in the Avenue Surrey Hills that went for $4.5 million, just under $4.5 million. Listings going forward in Melbourne, we're still seeing a rise, and that will act perhaps to push down clearance rates, but interesting to see just what the depth of buyer activity now is post-coronavirus shutdown. New listings are still rising quite strongly, particularly now driven by Melbourne coming back into the scene, Michael. So the new listed index now tracking higher than where it was pre-coronavirus. And we can see now that new listings in terms of where they're positioned compared to the same time last year are now tracking at that same level. So the market energy in terms of sellers is now tracking at the same levels as a year ago, which you remember was quite strong market environment. New listings to change over the week. Again, perhaps some holiday energy pushing down new listings in Melbourne. Other capital cities are quite strong in terms of increases in new listings over the week. But do remember the week before, we did have an easing of new listings data, so a little bit of catch-up happening there everywhere except Melbourne. And we do remember Melbourne the week before was very strong, so perhaps some consolidation of that. If we look at relative position there, Melbourne went from being the top performer in the volume of new listings the week before to being down compared to Sydney, just around 6% lower. Other capitals are around about the same, except for Perth, which fell away compared to Sydney. But Sydney remained last week after, I guess, losing its top position as had the highest volumes of new listings coming into the market over the week. Let's have a look at the selling environment now, Michael. And we've seen quite a strong revival in sales. These are newly reported sales on a week-to-week basis. Still just below where it was at the beginning of the year in Sydney, but certainly that the trend is onwards and upwards at the moment. Melbourne eased a little bit in terms of new sales growth, which we had seen coming through in previous weeks following easing of coronavirus. Of course, to be expected, well below the beginning of the year. I think there was, again, some holiday issues there, seasonal issues there that kept those new sales numbers flat over the past week. Be interesting to see where they fall this coming week. Brisbane remains still quite strong, strongest of all markets in terms of sales numbers, relative sales numbers, down a little bit compared to the previous week, but well ahead of where it was at the beginning of the year in terms of new sales in Brisbane. Again, Melbourne's new sales fell away, newly reported sales over the week. As I kept saying, a bit of holiday energy there, tracking the market backwards. Other markets are quite reasonable, although Adelaide and Perth fell away over the past week for new sales. And the relative position, again, Melbourne lower than it was the previous week in terms of its relative position for the volume of new sales compared to Sydney. Other markets track just about the same in terms of that relativity index. But we wait to see how the Melbourne market would be to be expected to bounce back this week in terms of new sales and new listings. So just a quick update on our monthly report, Michael. Average clearance rates over the month certainly increase everywhere except Canberra. Of course, Melbourne's clearance rates increased quite strongly over October compared to September. And the Canberra market, even though it eased marginally, is still very strong there, averaging a clearance rate over 80% both in September and October. Average listings, we can see listings were well up as well over the month compared to the previous month, particularly, of course, in Melbourne, where auction activity was virtually non-existent over September, and listings in Melbourne, average listings in Sydney continued to rise as well. Rental vacancy rates, we're still seeing higher vacancy rates for units. Michael, a lot of that's still that inner city, those inner city vacancies in Sydney, in the suburban areas, and the CBD in Melbourne. Of course, that's a product of that continual closed borders, particularly international closed borders, which are pushing more Airbnb, holiday accommodation, into the permanent market. But no doubt that house vacancy rates are significantly lower all across the board, really, in all capital cities compared to houses. We have seen falling rents in the unit market, Michael, no surprise, given the higher vacancy rates. However, rentals, although eased a little bit from houses over the month, are still up over the year, particularly in Melbourne and Sydney, and some of the other smaller markets as well. If we look at the median asking prices over October compared to the previous month, as has been reported by other price providers, we have seen an increase in Sydney, an increase also in Melbourne at the margin, and a slight decline in Brisbane. These numbers are volatile from month to month, but we're seeing some better results we can see over the year in terms of price growth, which do correlate with other models. Growth in unit prices over the month underperformed compared to houses, and however, in general, are higher at the same time than at the same time last year. And these are my predictions, of course, which we run at the end of the update. In terms of prices growth, I think they're going to hold pretty steady. I think maybe even that Melbourne result of a 5% fall this year. Now, this is the growth rate from the beginning of this year to the end of this year. I think all markets, in terms of houses, will find themselves above the line, with Darwin, Brisbane and Canberra the best performers. I'm not so sure Melbourne will. I think the risk's there that Melbourne won't fall as much as 5%, but obviously given the late year shutdown in the Melbourne market, now easing, of course, Melbourne would underperform compared to the rest. Just quickly with the economy, share market has actually risen quite strongly over the past week, reflecting perhaps the sentiment for lower interest rates, of course, the Reserve Bank cutting rates again to a record low and stating that they're going to remain there for at least 3 years. Also, interestingly, the dollar has climbed since that Reserve Bank announcement, which was to some degree intended to put downward pressure and should have put downward pressure on our dollar. But as these things typically pan out, not as planned, and the dollar has risen to near year highs. And of course, we have to understand there's some weakness in the US dollar because of the political situation over there. So that might be driving a higher Australian dollar, but we'd need to see a longer term, I guess, consolidation of sentiment to see if we're going to get that lower dollar as was planned by the Reserve Bank. Retail sales down just slightly, still well above. These are September retail sales, just well above where they were prior to the coronavirus. So consumers are still spending and at higher levels compared to pre-coronavirus. No surprise that easing in retail sales over the month was driven by Victoria's weaker retail sales environment over September. And we can see there when we look at retail sales growth since June that there's been a significant rebound since that coronavirus lockdown period everywhere except, of course, Victoria. So again, rationalising that government policies have worked, not just perhaps in terms of housing market activity, but also in the general economy as well, with as we know, a much improved performance in the labour market generally, and also retail sales have continued to be quite solid with the exception of Victoria. And of course, as we discussed last week, Reserve Bank cut interest rates to that record low 0.1, perhaps the last cut in the cycle. No increases for 3 years, the RBA has stipulated. The banks have passed on that rate to customers. This, of course, is positive news for the economy and housing markets and adds to the current economic momentum and certainly will help the Victorian revival. Puts downward pressure on the dollar. We haven't seen that yet. And the quantitative easing package that was also announced by the RBA, which is intended to lower those retail interest rates, and that's credit cards, overdrafts and personal loans, and provide a lower dollar, hasn't happened yet. And of course, it provides a funding source as the RBA purchases or stands in the market as a purchaser of state and federal government bonds. And of course, the RBA is talking that it might even start to think about currency trading going forward. And the share market and dollar volatility, maybe not so much a reflection of the US election results as has been speculated. So that's all for another very interesting week, Michael. Onwards and upwards for housing markets, and certainly we're moving in a very positive fashion towards the end of the year.
A lot of really good news there. And also this week, ANZ Roy Morgan's weekly consumer confidence index rose for the 10th straight week in a row. But following on from your comments about consumer spending, and that's obviously going to help our economy leading into Christmas, consumer confidence is now above the 100 mark, which means there's more people confident than feeling pessimistic. But in good news for retailers, the latest Roy Morgan report also said that Australians now feel it's a good time to buy major household appliances, and about a third of Australians expect their families to be better off financially next year than they are at the moment, and only 17% think they're going to be worse off. So putting all that together, if we are more confident, it is going to get the economy moving forward, isn't it, Andrew?
Well, it is, Michael. And I guess the other point is that we've heard now from the Reserve Bank that they expect September growth to be quite strong in the economy. So this recession will be a oncer in terms of 2 consecutive declines. Of course, it is a black swan event, and the rebound will be as a result of a black swan event as well. So again, we need to see things settle down a little bit over the coming year. But really, for all things, the way things have panned out, it couldn't have been really better in terms of, and that's not to say things haven't been bleak in a lot of areas, but in terms of the prospect for the economy, we've really done very well, Michael. And as you said, I think that in terms of the forecasts, which were really perhaps inclined to be media attractive, you really can't make forecasts when you're in an environment where you just don't know what's happening. And those that do are just really throwing darts at the dartboard, Michael. And that's what we've found out this year again. And I think, as we've always said, you look to the fundamentals, and prior to the coronavirus shutdown, our housing market and by and large our economic fundamentals were quite strong. So it was a bit about pushing the pause button. When we released that button, we've started to move on again to catch up where we were prior to the shutdown. And it looks like we're going to get there a lot sooner than many expected, Michael.
Well, that's good news for all of us. So I look forward to catching up again next week and hearing what's happening in our property markets.
Yes, thank you, Michael.